I'm Anthony Valeri, Director of Investment Management in Wealth and Fiduciary Services. Thank you for joining. Today, we'll take a look at seasonal trends in the stock and bond markets, and specifically whether it's better over certain times of the year to be a stock or bond market investor. Let's start by taking a look at the equity markets. Here we show the calendar year average performance, or calendar month rather, performance of the S&P 500 index. You'll see that there are certain months are worse than others, and September is upon us and is historically the weakest month of the year for the equity market. While many think October as the worst month for stocks due to some well-publicized historical declines, it's actually September with the weakest performance and weakest average return. Here we show data from 1980 to 2022, but this September weakness has been consistent going all the way back to the 1920s. So this is an ongoing phenomenon in the equity market. However, if we look over recent years, the S&P 500, if it's positive year to date through August, September average performance is actually slightly positive or roughly flat at 0.2%. If it's negative on a year-to-date basis through August, the S&P has fared worse, down 3.1%. On the positive side, what follows September is three of the strongest months to own stocks. So the October, November, and December period is the strongest part of the calendar year for equity market investors. One trend that looks to remain in track is the post-midterm election trajectory of stocks. For those of you that follow the market moment and our quarterly webinars closely, you'll know we brought this up during the midterm elections last year, and oddly enough, this trend remains very much on track. Since 1946, stocks have never declined in the 12-month period following a midterm election, and that trend, despite all the pessimism in late 2022, appears to remain on track. And barring a dramatic decline over September and October, the S&P will likely keep its positive streak following a midterm election. Now let's turn to the bond market and take a look at trends there. Here we show the 10-year Treasury yield and the average path of the 10-year Treasury yield over any calendar year. This is data from 1978 to 2022. And what you'll see is that the 10-year Treasury yield has a tendency to increase early in the year with a slow and steady decline over the remainder of the calendar year. Those yields typically peak in May before slowly turning lower. Treasury issuance is usually heavier earlier in the year ahead of tax season and contributed to the rise in yields earlier in the year. The end of the Japanese fiscal year in March had historically also been associated with repatriation of funds away from the Treasury market, but that role and that impact has declined over recent years. Still, this trend is very much reflective of what happens in the Treasury market, and we see that in performance. So reflecting the prior yields change, it's perhaps no surprise that since the launch of the aggregate bond index, February and March have the weakest 2 months of performance in the bond market, and it's fairly steady after that. For 2023, yields started the year along this course, but the Silicon Valley Bank failure in March sparked a flight to quality that led to lower yields in March. And then this summer has seen an increase in yields over the summer months. And a reminder that there are no guarantees to investing and that fundamental data will ultimately be the main driver of performance, but important to be aware of those seasonal trends if you're an investor. Moving to the municipal bond market, and we see a similar trend to that of the taxable bond market. However, given the greater individual ownership of the municipal bond market as opposed to institutional investors, March often brings about selling pressures as individual investors sell bonds to pay taxes for gains elsewhere in the portfolio. This impact has weakened in recent years, but March to April remains a challenging period for municipal bond investors. June also ranks difficult due to a surge in new issuance that often happens that time of year, while October has been weak due to increasing sensitivity to potential equity weakness in the September period. January strength, as you see here, is mostly a result of strength in the early 1980s, and that impact has faded over recent years, while July, August, and November, December have been the strongest times of the year for municipal investors. That recaps our look at seasonal trends in financial markets. And remember, although these trends do persist, as an investor, it's always going to be fundamental or macroeconomic data that ultimately dominates, but important to have these data points as an investor. I'm Anthony Valeri. Thanks for joining.